Hello, good morning, good afternoon to those joining us in various time zones. I'm Raymond Karam, the Chief Program and Development Officer here at the AGSIW. Today, we continue AGSIW's coverage of the economic prospects and policy challenges for Gulf countries as they battle the consequences of the coronavirus pandemic and low oil prices. And we're delighted to be partnering with our colleagues at the International Monetary Fund on the launch of this report on the countries of the Gulf Cooperation Council. I want to especially thank our colleague Tim Callan, the IMF Mission Chief for Saudi Arabia, and Daniel Kanda, Mission Chief for Kuwait and Oman, who is joining us to speak on this panel today. To help us better make sense of this report, we're joined by an excellent panel of distinguished experts. I'll make quick introductions and share their bios, full bios in the chat. Again, I'm delighted to welcome Daniel Kanda, Mission Chief for Kuwait and Oman at the IMF. Daniel has been an IMF economist for 22 years and is the lead author of this report. Joining us from Dubai, our good friend Monica Malik, the Chief Economist at Abu Dhabi Commercial Bank, where she works on building economic research to help inform the bank's decision-making. Dr. Malik has over 20 years of experience as an economist in the Middle East and North Africa, and is the author of several academic books and articles on economic development in the Gulf Arab countries. And John Sfakianakis, the senior scholar at Pembroke College at the University of Cambridge and an associate fellow with the Middle East and North Africa program at Chatham House. He's also the chief economist and head of research of the Gulf at the Gulf Research Center in Riyadh. John has lived in Saudi Arabia for many years and is a frequent commentator for Bloomberg, CNBC, BBC, CNN, and others. And moderating the session today is my colleague, Robert Mogielnicki. Robert is a resident scholar at AGSIW. He is an expert in the political economy of the Middle East and North Africa, and he's written extensively on this topic, and you can find his latest research on our website, agsiw.org. Before we start, I'd like to remind you all that this webinar is being held on the record. It is being recorded and will be made available on our website probably by tomorrow. Our audience is in listen-only mode, but you'll be able to ask questions through the Q&A function in Zoom as usual. And with that, Robert, over to you.
Thank you so much, Raymond. And I'll just reiterate what you said. It's a pleasure to be partnering with the IMF to launch their latest report. And of course, having the lead author here, Daniel, is going to put us in a good spot to talk about the key findings here and the implications for the region. And as Raymond said, we have other great speakers here today too, Monica and John. They're going to serve as discussants, give us some additional context, and handle what I hope will be some tough questions from the audience. I will reserve my right as moderator to answer the easiest of the questions that come through. So those ones will be headed my way. And the first thing I'm going to do is give a little bit of context here with just a couple minutes of opening remarks. And then I'm going to turn things over to Daniel to walk us through the report. As a difficult 2020 draws to a close, we have the chance now to take stock of where Gulf economies stand and where they're headed in 2021. With vaccines being rolled out, there is some hope for a return to normalcy and even the start of economic recoveries. But this is going to be a long, hard road, and that's especially true for Gulf Arab states. Facing a coronavirus pandemic and the oil price rout of early 2020, not to mention the consequences of a global economic slowdown, Gulf Arab governments have rolled out a number of monetary and fiscal policy measures. The monetary support policies tended to be more robust than the fiscal policy measures and the associated stimulus packages. Partly out of necessity and partly out of opportunism, Gulf Arab governments also pushed through a number of controversial reforms over the past year. Now, midway through the year, I wrote a report with AGSIW on the economic policy response by GCC governments. And the conclusion was that a radical change to the region's political economy had not yet happened. We actually saw a lot of familiar measures, labor reforms, tax reforms, growing government debt as a result of bond issuances. Some of these policies and measures have been more drastic than others, such as Saudi Arabia increasing value-added tax from 5 to 15% during a very difficult time for firms and consumers. Yet there is certainly a sense that some things have changed for good, that we're entering a new phase. The outlook for oil and gas markets and the nature of energy demand has likely shifted in a manner that is not to the immediate advantage of oil and gas producing states like those in the Gulf Arab region. Tourism, aviation, hospitality, retail, entertainment industries are also going to require substantial changes to adapt to new consumer preferences. But these are the industries that have formed the heart of traditional economic diversification efforts in the region. So what paths lie ahead for Gulf Arab states, and do the initial reports on 2021 budgets indicate that these states will continue to meet the coronavirus-related economic and health-related needs amid very serious fiscal constraints? And when and how should these governments wind down accommodative fiscal and monetary policies without disrupting the recovery process? I think some of the questions that I just put out there are going to be answered by Daniel and are certainly covered in this report, and we're going to dig a little bit deeper throughout the rest of today's discussion. So with that, I'm going to turn it over to Daniel and ask you to walk us through some of the key findings of the report. What are the primary challenges that you're following, and where do some of the economic prospects look a bit more hopeful? Over to you, Daniel.
Thank you, Raymond. Let me start by saying that, sorry, Robert. Thank you, Robert. Let me start by saying that the full paper was published today at 9 a.m. precisely, and on the IMF website, so everybody can go out there and find the full detailed paper. So what I'm going to give here is a broad summary of the findings of the paper. Next slide, please. Yeah. This is just a broad outline of what I'm going of the slides. The first parts will be talking about background, where we'll deal with the double whammy to the region from COVID-19 and the oil market shocks, and look at the impact of these shocks on the growth outlook as well as fiscal positions. And then we will look at short-term policy priorities, and then the key medium-term challenges, notably on fiscal consolidation and on structural reforms to boost non-oil growth. And on the structural part, on the fiscal part, we will have some details about the consolidation needs and the areas that we think should be a key focus for consolidation. And then we'll tend to a few remarks on the business environment and also on the labor market as well. Next slide, please. Yeah. I mean, the coronavirus shock is something that everybody knows about well, so I will not spend too much time except to note that in the case of the Gulf countries, the authorities moved relatively swiftly to impose lockdowns, social distancing, and other measures to contain the spread of the disease. And as well, and you can see on the right chart that, in fact, GCC, according to the Oxford Stringency Index, the GCC countries have overall had more stringent lockdown containment measures in place compared to the average. It is also apparent that after a peak in the middle of the year, the number of new cases has somewhat stabilized in the latter months. And next slide, please. Yeah. So on the oil side, you know, especially around March, there was a sharp decline in oil prices as the OPEC Plus talks initially failed, with one remarkable period where oil prices were in negative territory, but then followed by a new agreement that went into effect in May, which helped stabilize prices through the end of the year so far. And although there is now a new agreement going forward, which envisages some moderate increases in production, but combined with you know, a moderate recovery in global demand next year, it is not expected that oil prices would jump by, and the medium-term outlook is actually not all that encouraging for the oil market. Yeah. Now let's turn now to the next slide, please. Yeah. Now, the GCC countries actually made substantial efforts to put into place fiscal, monetary, macroprudential measures to address the challenges coming out of the pandemic and the oil shock on economic activity. The GCC is in the middle somewhere. It's all blue bars, but GCC is somewhere in the middle if you just look for it, and you notice that there was a fiscal response to the COVID-19. Policy rates also fell broadly in line or a little bit higher than what the Federal Reserve had done for the US, and which is not surprising given that they are practically all pegged to the dollar in some fashion. But then you notice that on the fiscal side, the fiscal stimulus seems a bit smaller than it would than comparator regions, and the reason is in part because lots of nationals work for the public sector and have not suffered job losses, and also the footprint of the state was already quite large to begin with, and so there wasn't that much extra that was done here. Let's see. Yeah. Now, I would also point out that there was a lot done in terms of encouraging banks to accept delayed payments from borrowers, and also liquidity support for banks, which helped to sustain credit flows as the contraction and the shocks hit the economies in the region. Next slide, please. Yeah. As a result of all these shocks, and notwithstanding the policy support measures, we saw very sharp contractions pretty much across the board in the GCC countries for non-oil real growth, and of course with oil growth also contracting as a result of the OPEC Plus agreement. Overall growth in 2020 is expected to be very negative, around -6 thereabouts, both oil and non-oil growth contracting. And then, but in 2021, a recovery is being forecasted by us, reflecting, hopefully the gradual ending of the pandemic, and a resumption of more normal levels of activity going forward. Next slide, please. Yeah. Now, the unfortunate part is that on top of having a sharp contraction, and as perhaps is not too surprising, with lower oil prices and oil supply comes lower oil revenues. On top of that, there's economic contraction, which is forcing, first of all, additional fiscal support measures and also dimming the outlook for non-oil revenues. As a result of which, across the board, we see fiscal balances deteriorating in 2020 compared to 2019. And even though some recovery is expected in 2021, overall fiscal deficits, with the exception of Qatar, remain quite sizable across the region. Not only that, sovereign debt, about $100 billion worth of sovereign debt is expected to be maturing over the coming years. And therefore, we are, and not only that, financing needs relative to, as a result of larger deficits, will also be rising. We think from about, by about 8.7 percentage points of GDP to about 13.5% of GDP in 2020, financing needs. So, financing needs are rising. Debt maturing in the near future is also large, and therefore the sovereign debt issues become significant as an issue to deal with. Now, however, the Gulf states have a lot of buffers, or most of them have substantial buffers and are able to deal with these financing needs, although these buffers are significantly weaker for Bahrain and Oman. I think next slide, please. So with all that said, the question we have at this juncture is what to do going forward. And it's useful to consider short-term and medium-term policies separately. In the short term, we are still not out of the woods yet as far as the pandemic is concerned. And so there is still a need to continue to be supportive. But at the same time, we can see that at some point in the not too distant future, things could normalize. And therefore, there's a need also to consider how to withdraw the support that has been given to this point. So on the fiscal front, it is important to continue to support social safety nets, to support affected small and medium-term enterprises, affected sectors, and also to assist unemployed expatriates who could not leave the region, as the authorities have already been doing. But at the same time, there are some, the measures that were put in place were relatively broad. There was an agency and, people generally supported with broad measures. But going forward, not all sectors actually suffered significantly. There are some sectors, such as IT-based sectors, that did just fine thus far. And so there is a need to begin to be more targeted in the support that is being given. At the same time, there's a lot of liquidity support that was given, but here also, as the crisis abates, central banks should be preparing to withdraw the liquidity support as the crisis abates. On the financial sector, these borrower support schemes should also be gradually withdrawn, and provisioning and other measures to strengthen buffers should be reinforced, especially because with the delay in borrowers servicing their debts, it is not clear from the it's not clear just how much of asset impairment has happened thus far. It will only become more apparent when people are asked to resume servicing their loans. And so there's a need to strengthen buffers to ensure that the financial systems in the region are able to absorb whatever shocks may come through this channel. Another issue that would be important is that since there have been different types of policy support, and if they are going to be withdrawn, the withdrawals should also be coordinated carefully. If you ask people to those who received tax deferments, for example, which many employers did, if you say people should suddenly pay more their taxes and also service their loans at the same time, this might be too much at the same time, and therefore timing is going to be important in how you withdraw the support. Now, but once the recovery is well established and the COVID issue wanes, then the medium-term outlook becomes more important, and policies should aim to strike a balance between achieving fiscal sustainability and supporting economic growth. Next page, please. Now, in terms of the fiscal challenges, let me start by saying that substantial consolidation is going to be needed over the medium and long run to ensure sustainability. And the reason for that is, among other things, very large non-oil structural primary deficits. The chart on the right gives you the regional simple average, which is a whopping something minus 45% of non-oil GDP according to this measure. Now, if you are starting from this point, and if you consider that over the long run, in coming decades, oil revenues as a share of non-oil GDP are projected to decline pretty much continually, then what is going to happen is that as those revenues disappear or shrink as a share of GDP, you find that the fiscal hole becomes larger and larger and larger and larger. Now, on one hand, given the large assets that they have and the investment returns that can come from that, it is not necessary that all these countries should ultimately run, 100%, zero balances. But it is necessary to go much closer to zero in terms of the non-oil structural primary balance in order to maintain sustainability over the long run. Many of the countries in the region have put in place medium-term adjustment plans that they are implementing. Some just started, such as in Oman, the medium-term adjustment plan was just announced. And so you notice that the black line, which talks about planned adjustment, incorporates the medium-term adjustment plans that have been announced across the region. And it is clear that significant adjustment is planned. However, given what we feel is the long-run sustainable level, which is around -10, much more will have to be done in coming decades to fully achieve sustainability. And the left chart shows, our benchmark projection about how oil demand is going to look like, and indeed, in about 2 to 3 decades, the expectation is that this curve will bend. And in fact, other agencies that are, I'm sure, even more knowledgeable than the fund about how the oil market will look like are even more pessimistic than we are about the outlook for oil and in the coming decades. Next slide, please. So this slide, we look at a few areas where we think are useful to look at across most countries in terms of the areas for fiscal reforms. The charts look at the public wage bill, which is high in several countries. The comparator here is advanced economies because that was the data we could readily find. But one might well argue that the proper comparator for the region would be emerging market economies, in which the public wage bill is certainly significantly smaller than for advanced economies. For fossil fuel subsidies too, the countries in the region have been making progress already to reduce them, but then it's given what's going on, and it will be good to continue to make progress in this area to free up space, to free up fiscal space. And finally, on the right chart, it is clear, the blue being the oil revenue, it is clear just how important oil revenues are to the countries in the region. And then therefore, as oil revenues as a share of GDP begin to trend down, these gaps, even at these levels of revenues, we see large fiscal deficits. And so the agency to begin to introduce a significant non-oil revenue mobilization is pretty clear. Now, on capital expenditure, for which we didn't have a chart here because there's just a limit on how many charts you can put into a slide. But on capital expenditure, what I would say is that it is also, there is a need also to look more closely at getting value for money for the projects that are in train, and also to look to see if perhaps these could be geared towards more green investments, given the outlook for the climate. Next slide, please. Yeah. Now, turning now to structural reforms. Now, this region has a large population of youngsters coming into the labor market in the coming period, and the usual way of doing things, in which many nationals found jobs in the public sector, with a sizable wage premium, cannot be sustained for much longer because fiscal strains are, fiscal positions really don't permit that. And as we just saw concerning the fiscal outlook, there's a need for adjustment to begin. once the virus issue and is put under control. And therefore, other ways will have to be found to employ the incoming nationals, and that can only be private sector employment. And so various things have to be done to improve the outlook for this. First of all, improved educational standards, which will have a benefit also in terms of improving the overall productivity of nationals, the overall ability of nationals to seize new opportunities that come down the line. Higher female participation is an obvious one. The public wage premium would have to be reduced, because what it is doing is to discourage nationals from entering the private sector, and in reverse, and discouraging employers from seeking out talented nationals to work for them. And so something will have to be done to adjust incentives in a manner that encourages nationals to seek out jobs in the private sector, and sort of double advantage being to relieve some of the pressure on the public system. And then last but not least, some balance in terms of the policies geared towards nationals and the policies geared towards expatriates would be good. Now, expatriates play a major role in these economies. They are, by some measures, if you include domestic workers, expatriates are almost 2/3 of employment in the region. And therefore, what you do to a segment that has 2/3 of employment is going to matter significantly for potential growth and even for productivity. And therefore, some balance will have to be found in terms of how these policies that affect expatriates are implemented and devised. I think next slide, please. I think this is pretty much near there. Oh, yes. And then business environment. We need a dynamic business private sector to grow rapidly and to provide good jobs for the people of the region. So for that to happen, you would need to put in place environments that encourage both domestic and foreign investment. You see from the left chart that after peaking around 2008 thereabouts, FDI inflows have dropped considerably in the region, and this will need to pick up quite a lot going forward in order to provide those new companies and those new jobs that people will need in the area. And then beyond that, in terms of the SMEs that are already existing, what we see is that as a share of GDP, they are very important to the region. And yet, if you look at SMEs as a share of total loans, not so much, which suggests that additional financing schemes to support SMEs will be necessary going forward in order to ensure that the private sector, which would primarily start with SMEs, will grow and deliver the kinds of outcomes that the people in the region will need to be able to sustain the living standards that they have grown used to. And next page, yeah. So just a few concluding remarks. As we've seen, there has been a double whammy to the region from COVID-19 and the oil market, with a strong adverse impact on economic activity and fiscal positions in the region. Commendably, the authorities in the region moved swiftly to contain the spread of the virus and to provide support. And the short-term priority is to maintain the support measures while improving the targeting of that support, and that the withdrawal of support will need to be carefully calibrated as the recovery is established. An important point is that medium-term and long-run fiscal consolidation will be needed to address sizable sustainability gaps. Now, several GCC countries have developed ambitious plans which augurs well, but of course, implementation of fiscal plans, global fiscal adjustment plans globally and historically has been difficult. And then structural reforms to boost non-oil growth and employment and to diversify away from oil will be very important to in the coming years. And I think I'll stop here. Thank you.
Great. Thank you so much, Daniel. Impeccable timing, bringing that to a close exactly when I asked you to do it, or within sticking to the agenda. So thank you very much. You packed a lot in there in a short time. There are 3 points of your presentation that jumped out to me, and I'm going to quickly go over those now as a way to bring Monica and John into the conversation, and then I'll round it out by addressing the 3rd point back to you, Daniel. In the earlier part of your presentation, I mean, slide 7 or so, you had a visualization of the sovereign debt maturity profile. And from a quick look, it looked like 2021 to 2023 is going to be a very tough time for some of the sovereigns in the region for meeting those external debt obligations. I think in 2021 and 2022, it'll probably, there'll be a lot on Oman's plate. And then in the latter part of that period, it looked like Saudi Arabia was going to have to deal with some substantial debt maturity. So I want to bring Monica into the conversation and say, and ask her, you know, speaking on debt, we've seen high debt levels before and also low oil prices, but are some of the policy changes and the economic prospects facing Gulf governments now substantially different than those witnessed previously? What do you think about this, and how is all of this kind of impacting your thoughts on debt dynamics?
Thank you. Thank you for reminding me of that, and thank you for this wonderful question as well. Yes, I mean, you know, if we look at the 80s and 90s, of course, there were periods of low oil prices. And before the sort of big rise in oil prices that you saw in the 2000s, you did see high government debt levels, particularly in Saudi Arabia in GDP terms. But if we look at the GCC as a whole, I think excluding Saudi Arabia, especially countries like Bahrain, Oman, the debt levels were much lower. We've of course had that big period, the period of from 2002 to 2014, where you had very high oil prices, government spending increasing very substantially, the budget break-even oil prices rising. So, you know, I think that's a very important position because the government spending level has been much higher. And even though we've seen oil prices come down and governments looking at the adjustment program, the budget break-even oil prices are still higher. We've had the GCC countries with weaker fiscal buffers now than they had in 2014 when they were entering the sort of lower oil price scenarios. Growth had not recovered to pre-2014 levels. Looking forward, Daniel highlighted very well the challenges for the oil market in the medium term. Indeed, in the short term, you could expect some increase as we have some normalization of global economic activity as we move out of the pandemic with the vaccines. But the medium-term outlook, the longer-term outlook looks challenging. And the labor market, the labor force that need jobs, the national labor force is substantially higher. So this combination of weaker fiscal buffers, weak growth, the need for jobs, and the government trying to balance these areas in a multi-year reform program while trying to create jobs and transition the economy. I think that the fact that all of these have come together does put us in a very, very critical stage. The positive side is we have seen reforms now that we've not seen before that are changing the structure between the relationship of the government and the people, but we have still a long way to go.
Monica, just pick up on one point. I mean, in the past few days, or maybe a week or two ago, Saudi officials came out and suggested that the government is probably not going to tap international debt markets again in this year. And it brings up an important point about balancing this external debt versus local debt and expecting more and relying more on local financial institutions. How is that balance playing out across the region? Where do you see some governments doing a better job balancing those two different sources of financing, and where do you see some potential issues?
Okay, well, I mean, I think the ability this year to have tapped the external debt markets has been essential for making sure that liquidity was ample. And I think, at the beginning of the crisis, that was the key concern, that, the region didn't face the same liquidity problems that they did in the global economic crisis, or in 2015 and 16 in the low oil price environment. But as we've seen that there's ample liquidity in the banking sector, we have seen more domestic borrowing as well. The lower interest rates domestically and globally has been a key support factor. But I think in Saudi as well, a lot of the borrowing this year hasn't come from the banking sector. And that's been really essential, again, to ensure liquidity is there when Saudi's got very strong, credit demand by the private sector this year. I think most countries have balanced it well. I think two countries that stand out. One is, of course, Oman, where concerns of the debt dynamics meant that the access to the debt capital market has been relatively limited. We've seen a reform program. We need to see more details and implementation, but that stands out. The access hasn't been there. Bahrain, with weaker fundamentals, has had access because of the GCC support package. And of course, Kuwait stands out as well. The fact that the government has not been able to pass a new debt law has meant that they haven't been able to issue either domestic or international debt, despite the low interest rates, despite low debt levels in Kuwait. And of course, funding of the budget is another challenge. So I think those two countries stand out at the moment.
Okay, thank you very much, Monica. We'll loop back to you in a few minutes. One of the other points that Daniel mentioned in his presentation, there was a great chart displaying the oil revenues and the non-oil revenues. And if I remember correctly, the non-oil revenues for Kuwait were substantial, and it might lead one looking at that chart to think that Kuwait is more diversified than some of its neighbors. But I think it's important to remember that a lot of those non-oil revenues are probably coming from financial resources that have directly come from the proceeds of the oil and gas sector. And if we're looking at a scenario where Kuwait's going to have to tap those financial resources over the coming years to make up for its growing deficits, then the returns and the yields on those financial assets are going to decrease over the medium and long run. So that brings me over to John. I mean, how realistic is it to expect Gulf governments to make genuine progress in diversifying government revenue when many of the hardest hit sectors in the economies are these traditional areas of economic diversification efforts? So why don't you walk us through some of your thoughts on economic diversification moving forward?
Thank you, Robert. Thank you. So I believe that the attempt to diversify is neither easy nor is it immediate. And I think that has to be widely understood within the region and outside of the region. Policymakers need to understand that within 2 years, you cannot diversify an edifice that has been there for 60, 70 years. And the rent-seeking capacity of the state, if I were to use this term widely, cannot be deconstructed just because you have a vision or the entire region has a vision or several visions. So it takes a lot of time, a lot of effort, and there is an element of fallibility that the leadership of the Gulf countries have to realize, that there is a lot of trial and error, and probably more error than trial. And one has to accept the mistakes that are being done. It's very difficult also for the fund and other international financial institutions to just offer advice. It's very difficult for them to do it and for economists to do it because it hasn't really been done. And it's very difficult to come up with examples, best practice, and hire a management consultant and he will tell us how they did it. Well, it's very difficult because nobody really has done it. And it has to do very much about the politics of the region as much as the economics, about the geographical location of the region and what's happening in places such as, you know, Iraq and the Levant and other places that impact very much the Gulf. The Gulf is not insulated, but another element that one needs to keep in mind is that you know, to expect for these transformations to happen overnight, it's just unrealistic. I'll go back to my initial point. Another lesson learned in here is the lesson learned from the past five and a half years of trying to reform in Saudi Arabia with obvious successes, but also challenges. But in the wider Gulf region, is that oil is very important for them to diversify. It cannot be done with very low oil prices, nor for the policymakers to expect that if we have oil disappearing, they'll be able to diversify. So oil needs to be at a relatively medium to high level. With oil at 40, I don't think it's going to be done that easily. And second of all, it's very important to move away from this notion of pro-cyclicality. Creating non-oil revenues from oil-based economies is very much oil-related. So, you know, going around saying that we have created non-oil revenues, it's really a fallacy, and one needs to rethink that element of economic policy. And I think what Daniel referred to is very important. And I would say the role of FDI is very important, and Daniel addressed this issue a little bit. But it's not just the role of FDI, it's also the role of the private sector. So I would say that FDI, again, is very important, and it's very much needed at times such these. And also the private sector participation is very central. It's very difficult to expect, and they're both very connected. It's very difficult to expect the local private sector to participate and to be asked to do things whilst a foreign direct investment is not there, and the opposite. The two go very much in hand. And then there is another point that I see very much present, not just in the Gulf, but in the wider Middle East economic arena. There is very much an attempt to bring back the state. There was, you know, a book back in the 1990s by Evans and others who wrote about the attempt to bring back the state. And I think bringing back the state in the economic fold is something that has to be looked at. And it's not a COVID event. We see this happening throughout all the economies, if not most of the economies of the world. COVID has reinstated the state, but more so in the case of the Gulf and the Middle East, the state is coming back. And the state today is an entrepreneur, the state is a developer, and this state capitalist model that we have seen in the past in China and today is something that is hailed as very important in the Gulf. And I think there is a problem here with this. You cannot ask your private sector to invest and be very engaged whilst you want FDI to come in, whilst you have very strong state capitalist attempts. One needs to give. You cannot have all three happening. So that is important. And then finally, I would say that what is equally important is for the governments to reprioritize in times of crisis. And we've seen this in the 1990s. The literature is plentiful. Economic crises need to create certain urgent economic reforms. And we've seen that, yes, they've taken the right measures, but then again, certain countries decided to go with counter-cyclicality and others with pro-cyclicality. And in the case of Saudi Arabia, to enact rules that would extract more revenue from the economy at a time when it's very challenging to do that. So I would urge them to prioritize, because nothing can be done, and not everything can be done at the same time. So what is really, let me say a few words, a couple of minutes on what is the future looking like for somebody that has been looking at the region for 17 years, and Monica has been doing it, and others for a long time. So I would say that do not go and destroy what has been built just because there is an impending crisis. And for sure, the last 5 years have been very challenging. I'm ready to say to policymakers, the next 5 will be even more challenging. And I'm not going to get into the debate of peak oil and what's the oil price. And if anybody knows, please give me a call. I'll put a hedge. But obviously, oil prices are not going to go back to $100 anytime soon. However, something has been working in part, and that cannot be destroyed. So suddenly, the region is not going to rid itself of the petrochemical sector, industry, certain industries that have been working quite well. This cannot be destroyed just because oil has gone down. That has to be taken into consideration. The other thing that I would urge is, stay away from vanity projects. Yes, some can work, but others cannot work. And one needs to be truthful to that. And it seems that all Gulf leaders are falling into the same trap. They all want to continue to have big projects, fantastic destinations, and wonderful things about the future. And I would say that I would urge them for greater harmonization within the GCC. I think this is very much needed, although I will say this, and next day the opposite will happen. Not the entire Gulf cannot have the biggest airline, the greatest hospitality destination, and for 200 million tourists to be flocking the Gulf. It's simply not going to happen. And we'll just kill each other competing and then wasting a lot of needed revenue. And then finally, I would say that there is an important role for economic planning and economic coordination. And I think that is also lacking from many of the countries. Although they have visions, I would argue that economic planning is still lacking, and equally economic coordination is lacking. And that's what makes it more difficult for them to really catch up. And they could do everything very well and still have not very good results, not necessarily because they have taken the wrong decisions or because they're stupid. On the contrary, I still believe that there is an element of optimism. But the reason for not being able to do it enough is because everybody else outside advances faster, innovates quicker, uses technology, has better skills, and they are able to much faster adapt into this new world that we're going to be in over the next 10 years. That's all I wanted to say. Thank you, Robert.
Thank you, John. Just to follow up briefly on something you mentioned, I mean, I was struck by what you're talking about, how economic diversification has to be realistic. And Daniel mentioned in his opening remarks about Oman's medium-term fiscal plan. Well, I think that the details we have anyway of the fiscal plan indicate an increase in non-oil revenues from just 28% this year of total revenues to 35% in 2024. I mean, that's not a very ambitious target. So my question to you very briefly before I go back to Daniel is, in your view, and based on what you were saying, is this not enough, or is this just being realistic? What's your take on it?
You need to understand that as you're extracting this revenue, there has to be a similar attempt to insert something back to the economy. So yes, you can tax your citizens, and we have seen this in other cases, especially after the financial crisis in 2008-09, and especially in the crisis countries, Ireland, Portugal, Spain, and Greece, where certain countries adopted high taxation, and then the return was not as expected. So I think as they are creating these non-oil revenues, they need to be giving back something. So it's not exactly just a mathematical calculation. Yes, the attempt is very noble because it started from a very low base, but then from here on, the impact could be far greater than what you're extracting in revenue terms.
Okay, thank you, John. I'm going to loop back now to Daniel. The third point of your presentation that really struck me was the gap in SMEs' contribution to the GDP of GCC states and the percentage of total loans that were going to SMEs. So I guess my question is in two parts. How do you explain that gap, and what are the key reasons for it, and what can be done to address the gap moving forward?
Thank you, Robert. I think the gap is probably not unusual in general. It's a well-known fact, not just in the region, but I think across the board, that small enterprises have greater difficulty accessing financing from banks for various reasons. You know, the loan size is small. The administrative costs are probably similar to what a bank would envisage for a much larger loan and much larger profit outlook. It is and therefore, given the ability to look closely and evaluate properly the borrower is also more limited, because paperwork and paper trails are more limited for smaller companies. So all these things lead to issues of banks simply having more difficulty to reach a place where they are confident to give their loans. And even where they have this confidence, also the size of the loan that is being given not being particularly attractive as in terms of a single unit, in terms of the profits that might come out of it. And so SMEs, generally speaking, have more difficulty accessing bank loans, especially. And the region is no different. I think the thing to do, which some countries in the region have done, is various credit guarantee schemes that can help banks, at least in the case where the assessment of risk is not favorable. These kinds of credit guarantee schemes can definitely help to facilitate bank lending. Beyond that, to measures to improve credit reporting and credit assessments to make it easier and more straightforward can also help banks in assessing creditworthiness of borrowers, and therefore also facilitate lending. But at the end of the day, these measures will help, and some have been attempted in the region. I think we even have an appendix with some detail about country by country in the report. But these can help and will help if implemented and expanded upon. But I think that it will probably always be the case that larger companies will have an easier time getting loans from banks.
Okay, thank you for that, Daniel. I'm going to shift now to some of the questions that are coming through for our speakers. The first one has to do with the topic of FDI, and we saw from Daniel's presentation that FDI trends have largely been on the in a downward direction or downward trend since about 2008. So one of the questions is, why exactly is FDI so important, given that these states have enormous pools of sovereign capital relative to the size of their non-oil economies? It seems like these economies have a shortage of growth assets rather than investable capital. I would add to that, I guess, question, one of my own. What do the speakers see as the key barriers to FDI in the region? I mean, we've seen the UAE coming out recently with new reforms to foreign ownership in at least in the UAE. We've heard about this for the last couple of years, but anyway, that has been marketed as an effort to increase FDI. So I guess I'll start with Monica on the FDI questions, and then I'll also loop in John and Daniel as well.
Thank you very much. I do think FDI is important, but I think not all FDI is the same, and that needs to be the difference. Of course, yes, some of the GCC countries, many of them have very high reserves, but these again should be invested partly at home, but also overseas. Taking advantage of other capital coming in is very beneficial. I think also the fact is, if you bring in, if we look at a project in the GCC, a lot of the projects, for example, in Saudi that are starting to gain traction, if you just have FDI coming in to support the construction or the infrastructure building. That's positive, yes. But I think bringing in FDI that brings in new industries, brings in new technologies, helps to drive key sectors. And that to me is critical. And that's also an area to me which has not been large enough or sufficient enough. And I think, you know, to the points that have been made by John, Daniel, Robert as well, I think a key point is that, yes, a lot of the sectors that have taken us this far are not going to provide the same area of growth. For example, in the UAE, real estate, we've got oversupply in there. A lot of the sectors are being duplicated. So as John said, you can't keep building. There's a significant need for new industries to be developed. I think a key hindrance has been the labor market, the domestic labor market, the skill sets, even the requirements of the private sector aren't always fully met by the output of the education system. So I think that's key to number one. And I think, you know, building on what Robert said, I think the reforms that the UAE has made really highlight the changes that need to happen in the business environment, the ease of doing business. And these are very important steps as well. So I think, you know, the purposes of attracting capital, skills, new sectors, I think FDI has a large role to play. I think it will be difficult going forward because the COVID crisis will leave global scars. We're going to have higher global tax rates, fiscal positions of other governments, companies are going to be difficult. But I think, you know, having a labor force that can attract the FDI for new businesses, new sectors, that's going to be really, really critical. And a competitive labor force, because, you know, of course, one thing we talk about quite a lot is the cost of an expat employee versus a national employee. And that's one of the problems that the private sector faces with the labor nationalization programs as well, productivity and cost.
Thank you, Monica. John or Daniel, would you like to weigh in on the topic of the FDI? Yep, John, I see you raising your hand. You know, of course, the first part, why is it important in your view, but also what do you see as some of those key barriers that still need to be overcome to help, you know, improve, make some progress on that trend that hasn't been very encouraging since 2008. I'll let you take the floor.
Yes, thank you. So, you know, FDI is important as much as you can fulfill the growth obligations and goals of your country, but also it's important if you don't have those domestic sources of investable capital, you need to find it from outside. But also you need to bring in what Monica said is the technology, the skills, the know-how, and that is really difficult to do it. Traditionally, FDI has come into the region when there was a petrochemical plant, an oil-related, hydrocarbon-related project, and it was based on two principles: capital, very cheap capital, and very cheap labor. Today, this is not happening. Although capital is very cheap, cheaper than back then, it is more challenging because capital is not plentiful. It has to be distributed to other sources, other investable projects. So it's not plentiful, and oil price is not helping the oil price. The other thing is labor is a challenge because they're trying to nationalize their workforce, and productivity has remained abysmally low. And while you're trying to do that, and this is probably the challenge, and maybe there is a certain, I wouldn't say uniqueness, but because every country is unique, you know, I hate when people try to compare and contrast the Egyptian economy with Korea. You know, yes, back in the 50s, Egypt had a bigger economy, but that doesn't mean a lot today. So I would say that it is important, but at the same time, FDI has to be attracting. And if you cannot attract to a certain degree some money into your economy, that is a problem also for your existing private sector. Having said this, I think before they start thinking about attracting again FDI, they need to think, and this is where the crisis mode will help them, where exactly do they want this FDI to go in? Because obviously it's not going to go into necessarily, again, petrochemicals, although that is a natural conduit. They do have a competitive edge, but they need to think, what are the sectors that will help them export higher technology content, where they will innovate, and a very complicated issue, which is, do they use the national workforce or do they automate? Because there are two contradictions to all the industrial policies of the Gulf. They want to automate and then create jobs. They cannot do both.
John, that's just before we go to Daniel, you brought up a point that responds to another follow-on question here. It was directed just to you. You mentioned the vanity projects in the tourism sector. What sectors do you see as better alternatives for government spending? I mean, what sectors would you prioritize or advise governments to prioritize to attract that FDI that you were just speaking about?
I mean, I don't think that I have the privilege to think alone. Others have done it before me. But I would say, again, industry is something that Saudi Arabia and the UAE can look at. It is not a sector that has to be deleted and then we create, out of thin air, a new sector. This is one. So it's not, again, I'll go to the initial point that we have something that is workable. Let's make it better, right? That is important. Two, yes, I would say that hospitality is important. It is something that brings identity, but also value added. Religious tourism, if I am to use the term, can create jobs, services. Non-tradables is something that is a definite plus if they're able to lower wages, because in real terms, wages are still very high. So it's not very competitive. And they are being aided by the weaker dollar. So the inflow will help that. But again, I wouldn't say that spending a huge amount of money to bring in tourists will necessarily make the difference, whilst everybody else is doing the same. Abu Dhabi, Dubai, and the immediate vicinity being Egypt, Jordan, and of course, Israel. So yes, some of them will come, and this is a definite plus because the country will open up. I'm referring to Saudi Arabia, but necessarily bringing in the numbers that they have been thinking of is probably a challenge. Third, I would try to think about how I will bring in skills and technology, and that's not an easy thing. Certain sectors like renewables, difficult, but more workable than 10 or 15 years ago. And finally, I would say that another sector is related to that, pharmaceuticals. Not easy, but something that could work.
Thank you, John. I know that a lot of consultants pull big salaries to give that advice, and I'm trying to eke it out of you for free here on Zoom. So appreciate you bearing with me. Daniel, thanks for your patience. I'll let you have the floor to discuss your thoughts on FDI and these questions.
I think I fully share the views of Monica and John. I would say that when you think about FDI as a country authority in the region, you would have to also put yourself a little bit in the shoes of the foreign investor that is considering an investment in the region compared to other options that they may have, and ask, why would they choose to locate in any country in the region rather than elsewhere? And this oftentimes goes towards, can they see that this investment will lead to substantial profits in the short, medium, and long run relative to other countries? Ultimately, the profit motive drives these considerations. And so if you are looking at, and if you want to be in a place where economies are adapting, moving rapidly, many new ideas and exciting companies are also in the same space, and so on and so forth, then it becomes challenging for the region. As some have said, there's a lot of duplication and so on. And also, issues related to ownership of ownership shares of companies are present here, which may not be the case in other regions of the world. The wages of nationals, which the wage premium for nationals being significant, also means that it is probably going to be difficult to hire nationals. And then if you are going to be hiring primarily expatriates to run a business, the question that a foreign investor could reasonably ask is, then why don't I go straight to the original country of countries where these people are coming from? And so it becomes challenging as you go through that thought process. I mean, a lot of times people ask the question about which sectors should country authorities promote. But sometimes it is better to look more broadly at about broader competitiveness issues as a first step, and not ignore them even as you go along. It's easy to build large projects. It's easy. Hospitality is a natural in the region and so on. But once you want to break out of that into new industries, then these issues of general competitiveness and attractiveness to investors become prominent and will have to be dealt with in some fashion if foreign investment is to play a substantial role going forward. The alternative, even if there are large pools of domestic capital to be used, it is still the case that, as one of you said, the rest of the world is moving faster, adapting faster, and so on. And therefore, if you want to join that train, you will have to do, I think, some of the things that others are doing that may not be pushed strongly in the region, as a way also to sort of join the bandwagon. I think I'll leave it there.
Thank you, Daniel. I'm going to shift now and address a couple of questions to each individual so we can knock off a few of these of the questions from the audience. The first is going to go to Monica. And the question is, what is the outlook for the fintech landscape in the region? Could this not be an avenue for SME growth in terms of funding? I'll just say briefly that, of course, if we look across the region, there are some emerging fintech hubs. Bahrain has made a big push with Bahrain Fintech Bay and the fintech hub that was recently announced by the central bank. Of course, the UAE is also another hub with in Dubai and Abu Dhabi and other Emirates as well, making a push there. So, what do you think, Monica? Is this what's your thoughts on this being a promising avenue for SME growth in the region?
I think it is a promising area, and not only are we seeing sort of fintech sort of companies moving in, we're also looking at a lot of financial industries looking at how you digitize, how you improve productivity. Again, as big parts of the economy shift to a more digital platform. But then I think, again, I'd like to highlight there's two things. As we have these processes, you actually, the need for human labor, automation, etc., actually becomes less. So, corporates become more efficient. Secondly, it's one technology replacing another. I think the critical point is that however much this industry develops, it's important, it's good to have that, it's good to move forward with that. Is that going to be able to bring sufficient new demand, create sufficient new jobs? I'm not sure it is. And I think, what's really going to be critical if we talk about diversification is what's going to drive the demand in the real economy. And even, I think some of the points that were made before about a cyclical economy, the nonoil revenue, a lot of that still comes from government spending of either oil savings or oil revenue being recycled and processed through the economy. So fintech effectively responds to demand in the economy, but we need to have more job creators, demand creators, inflow of capital, opportunities for creating jobs. That could be a part of it, but by itself, it's not sufficient in my view.
Thank you very much. The next question is for John. And I guess Monica's comments there about injecting capital and how that, and where that capital is coming from is a good segue to this question. It says that the Saudi PIF, Public Investment Fund, has stated plans to inject $40 billion annually over the next 2 years at a time of lower oil prices. Given that the sovereign wealth fund's mandates are to supplement an economy during a downturn, is this seen as a one-off by the PIF or the beginning of a strategy to resurrect the economy over the medium to long term? What do you think about that, John?
I think partially you need to ask the PIF if this is going to be a short-term or medium-term policy. But certainly the mandate is a challenging one because sovereign funds traditionally have not so much done the domestic expansionary growth crisis management side in a very successful way. And I think sovereign funds should be more directed towards the external side of things. Having said that, it all comes from a common pool. So still, the 40 billion will come from somewhere, and it has to be wisely invested, even if it's 1 or 2 years. So it has to be considered that this money will be going into productive, let's say, projects that have sustainability, longevity, and that is not easy. Again, not because the location or Saudi Arabia is at fault, but it is not easy to bring in all those complexities, create jobs, value add, sustainability, and for all of this to be working well and square it out. So I think that the sourcing is important. The fact that the PIF is trying to lead the efforts is something to take notice of. But equally, it is important also to be transparent as to how these steps will be taken. What are these investments? How is it going to be creating benefits for the economy? And for this to be coordinated with the rest of the sectors and mandates that are in other ministries in Saudi Arabia. So I would say yes, but then there is need for more clarity. And I think that is important because going back to Daniel's point, he was alluding to FDI being something of a transparent effort. And I think the more transparency you have, the more clarity you have as to what exactly is happening.
Okay, thank you. To Daniel now, a brief question about an alternative adjustment strategy. What about a managed devaluation of the GCC currency pegs? Is this a promising strategy in order to help with diversifying industries across the GCC? If not, why not?
Well, let me start by saying that a devaluation in the GCC is not without substantial costs right up front. Most of the GCC debt is in foreign currency, and therefore, if you devalue, you immediately create a significant spike in the debt to GDP ratio, and that you have to deal with that, through additional adjustment going forward. And therefore, it is not clear that a money devaluation by itself, without dealing with the fundamental issues, would do much good. It is better, I think, to deal with the issues more directly. If there is a fiscal sustainability issue, then dealing with that would, and if it is also clear that the outlook for oil is not brilliant, then what you have to do to adjust to keep your fiscal position sustainable is not going to be dramatically changed by devaluing. If the idea is that devaluation would support higher growth, which in turn would support fiscal consolidation efforts, all the constraints that we've talked about to FDI and so on would not necessarily be addressed by devaluation alone. There are many other things that would have to go into this. Not only that, just generally speaking, I'm not talking about the region, but just generally, if fundamentals and policy frameworks and so on remain broadly unchanged and you do a step devaluation in any country, essentially you are only buying time. These issues that go towards reducing competitiveness will remain and will just claw their way back. And so you do have to deal with the fundamental issues. And not only that, it will be, I think, a strange sight to see a region with such ample resources just devalue. It would raise questions about their ability to forge the appropriate path forward, with not a very clear short-term benefit to justify doing this.
Monica or John, would you like to weigh in here? And this is a question from time to time, and get outreach from reporters and saying, is this the time when the pressure on currency pegs is going to be too much? Is there going to be devaluation? I think there are a lot of questions out there about currency pegs in the GCC. What's your take on it? My perception is that Gulf governments, more or less across the board, are committed to maintaining their pegs, that it's an important part of investor confidence, and will do so as long as possible. I'll be curious to get your thoughts as well to supplement what Daniel has said.
I absolutely agree, and I think that reserves are still there, sufficient enough. I think the fact that these pegs aren't the traditional pegs that you see. These are the rates that central banks buy and sell their domestic currency with domestic banks. So, supporting the peg doesn't mean at times of overseas pressure or speculation that they're actually using their reserves. So I think that's an important point. And I think also related to the whole subject of attracting capital and FDI, if you have a more flexible currency, then perhaps a central bank would have to have more intervention to keep it stable. At the moment, it's a very important factor for overseas investors to see that there's a long-standing currency peg, and I think it actually supports investments. I think social pressures would increase if you had a marked devaluation as well, and also with most of these countries, barring sort of UAE, which has suffered from the strong US dollar vis-a-vis its non-oil sector. I think most of the countries, while they're looking to transform, having the stability of the dollar provides far greater support factors rather than a hindrance at this point.
Yes, Robert. The perennial question about the currency. So, I mean, it seems likely that we are now entering another phase, probably a structural phase in where we're going to see a weaker dollar. So this issue will come up again and again in the coming years. The answer is that, well, at some point, it depends in relative terms where your oil price and your oil revenue is. If oil revenues continue to go down and you have pressure, that pressure eventually will have to be eliminated, right? So it's with low oil revenues, the current policy is not sustainable, but we're not there yet, right? And I agree with Monica that I don't think that it is wise of the countries in the region to decide now to depeg and devalue. That will be the wrong thing to do, the wrong message, given that we are in this scenario of maybe structural shift. Eventually, however, and eventually I don't know, but it is more kind of a medium to long-term scenario, they have to reassess the currency. That is an unavoidable issue that has to be looked at. However, the big however is that anything that they do has to make sense with their macroeconomic policy and priorities. If their priority is to export, then obviously if they devalue now, this is the wrong time to be devaluing and thinking about the currency. If their attempt is to bring in FDI, this is not the time to be doing it. And if they do it, they need to think far more strongly about the impact it will have on their import appetite, because they're very much still dependent. They haven't yet localized, although all of them are trying to do so. So that is an issue. But I don't think that they will be doing it now, and I don't think it is wise. Do they have the fiscal buffers? Yeah, they do. I mean, Saudi Arabia can go all the way to 150 to 100 billion dollars and still stay healthy, and that is not an issue. And from time to time, whenever Oman has a fiscal issue, the currency props up and everybody starts debating it. And then now that Oman has addressed it, short-term wise, I think that issue will dissipate. One last, if you allow me, Robert, one last part, I apologize, something that I forgot to mention, is that whatever is done, whatever governments decide to do, and especially to your question of investing in the local economy, you asked about the PIF and all that. It is important that the PIFs of the Gulf do it in tandem, do their investments locally in tandem with the private sector. This is very crucial. The private sector is a very important element to everything, because this is how you are going to create growth. It's not going to be done just because of one entity, just because one entity has access to funding. It has to be in tandem, because this is the Gulf still has wealth. This is not Egypt. A lot of my colleagues ask me, well, is the Gulf going the way of Egypt? No, I would say this is not Egypt. This is not Lebanon. These are very different locations. Iraq is in very bad situation. Lebanon, same. Zombie economies. Syria. The Gulf is not a zombie region, right? And so I would say there is still wealth, and the private sector needs to be brought in. Thank you.
Thank you, John. I'm going to ask one brief question for Monica and Daniel on Kuwait, and then I'm going to just put out a kind of some parting remarks on oil prices and looking ahead, and give each of the speakers just a chance to bring things to a close, because we are reaching the end of our allotted time. But on the question of Kuwait, we have that just came through. It seems as if Kuwait's quickly approaching the point where general reserves are depleted, and yet there doesn't seem to be momentum toward passing a new debt law. Monica touched on that earlier. Are they heading toward for a hard budget constraint? Monica and Daniel, this one over to you both.
Something has to change. It can't continue like that. And, it's very telling that this is the first year that, despite Kuwait having large reserves with the Fund for Future Generations, they were downgraded, I believe, by Moody's because of this budget funding and liquidity constraint. Though there was hopes that a new debt law would be passed by now, but after the elections that just took place at the beginning of December, it seems that this contentious relationship between the cabinet and parliament is set to continue. We have seen, there's various options that can be done. The General Reserve Fund borrowing from the Fund for Future Generations, asset sales. We've already seen some compromise when it had reached crunch point with the sort of reserves going to the Fund for Future Generations. But I think the trends that we've seen so far indicates that you have to get close to crunch point before something gives in this political relationship. So I think it's still very uncertain. But I think it can't continue like this for the medium term. There's no space. So either there has to be a compromise, or there has to be a significant structural change.
Yeah, I think I agree with Monica about all that she said. Something definitely has to change. This is if a liquidity crunch were to emerge, it would be primarily because of gridlock. Internal gridlock, rather than their rating or their ability, even from their own resources, to fund their deficits going forward. And so we are now really in the realm of politics and brinkmanship as far as who will give in first, and when will a deal be made as an impending crunch approaches. I think eventually, as things tighten up and as the liquidity buffers in the General Reserve Fund draw down, enough people will conclude that they need to make a deal to make that deal happen. But before that, probably there'll be a lot of back and forth before we see something like that happen. And not only that, it's one thing to do this when you are not yet downgraded. It's another thing to begin to see evidence of significant consequences to this thing continuing. And I would presume that if Moody's has downgraded them, then other agencies and investors and so on are also looking closely at the situation, and therefore the pressure to do something will also increase over time. And so it's not so constant. And at the end of the day, one thing no politician wants is to preside over a catastrophic event. So I think they will figure it out, but with a lot of back and forth, I think.
Okay. Oh, sorry, Monica.
Sorry, Robert, just to add to that, and I think the crunch point will be when, as it was last time when there was some compromise, is when the government won't be able to pay its wages and its salaries. And with most nationals working for the government, I think, that will bring both sides together. But, it's a shame it has to get to the point that we're at even now.
Thanks. Okay, great. That really brings us to the last point here. We had a couple of questions on oil price dynamics and how they factor into the short and medium-term outlooks for Gulf Arab governments. So I guess to give you a hard question at the end, or at least a short amount of time to answer it in, I'll read out these kind of two questions and then allow you to use this to segue into some parting remarks. And one of the questions talks about a rebound of oil prices in 2021. If that happens, will that undermine momentum for public reform? So it's kind of an optimistic look at oil prices that would have potentially a negative impact. The other question says that the report is very optimistic on peak oil demands if we look ahead at 2030 or 2040. Do we believe this is a dangerous base case for Gulf states to work with? So two slightly different kind of outlooks. Where do you stand at the moment in how you measure the relationship between the oil and gas outlook and the consequent impact on Gulf Arab economies as we move into 2021 and look farther ahead? If you can give us some parting thoughts, that would be much appreciated. Maybe we'll start with John.
All right. So I cannot tell you with confidence, nor I would profess that the oil price is something that I can predict with any form of scientific way. I mean, it's just beyond me. Having said this, I think that there is, as we were in March and April talking about the gloom and doom of the Gulf states because oil was sinking and my God, what will happen to them? We are in a bit of a groupthink situation where now we're talking too much about the peak oil that is with us, and is it going to be 2035 or 33 or 37? And the Norwegians are buying electric vehicles, nobody sells cars. I mean, the fact of the matter is that peak sales for cars, vehicles in the United States has taken place a few years back, and probably it's not coming to the modum vivendi of the internal combustion engine. So probably that is happening, but it remains to be seen. The counterweight to that is that yes, if we don't see a lot of investments, at some point demand is going to return, and we're going to see this oil price hike. And already oil is at 48 something or 47 something, and that's good. And next year we can be at 55, and from there on. But I do not think that policymakers need to be fixated just with the price of oil. I mean, it's very important, as I said at the outset of my brief, that if anything, this crisis teaches us that in order to diversify, they need oil. Having said this, I also do not believe that oil is just going to disappear and that's it. But policymakers need to be very disciplined, and that's not easy for any country, not just the Gulf, to discipline themselves that economic reforms need to be steady, while at the same time they need to make the region attractive, do not have difficulties with geopolitics in order to attract some FDI, and also keep the money in the region. A very important part is that the region could end up being, over the next 10 years, we could see a lot of capital outflows from the private sector because there is less confidence in their own economies. So, I would say that let's be a little bit more conservative on both sides. Peak oil, where tomorrow the Gulf is going to disappear, and at the same time, or we're going to go back to the 150 oil. This is not going to come back anytime.
Thank you, Monica.
I'd like to take the slightly different aspect. You had talked about if oil prices rise next year, going forward, what will that mean for fiscal policy? And I think, this is really the crux of the challenge we're in now, and where we started off. It's the fact that we've still got budgets in deficit, budget break-even oil prices are still on the whole, or in all cases, higher. It's an expensive transformation plan that needs to be funded, and social pressures have to be, sort of also, we can't see social pressures building up. What we've seen in the last few years is, after you've had 1 or 2 years of strong fiscal adjustment, when oil prices go up, you do seem to see current spending going out, social handouts going out to sort of ease the process. And I think that's the difficult point that we're really in, having a multi-year fiscal transition program where oil still is central to demand, and the government is still in the key to demand in the economy. So I do think that maybe not next year. I think, for example, the Saudi budget is very focused on bringing the fiscal balance more towards its medium-term objectives. But say in a year or so, after having 2 years of VAT increasing pullback in spending, if oil prices are supportive, even up to the $60 level, you could see some paring back of the fiscal reforms. It's not going to be easy.
And to Daniel for the final comments here.
Well, are we being optimistic on the peak oil demand? Probably yes. The chart shows that other agencies are more pessimistic, especially over the near term. But that then really brings our focus more towards the agency of the need to do medium-term fiscal adjustment, put in place proper frameworks that allow this to be done consistently in a disciplined fashion, regardless of what might happen in the short run to oil prices, and keep going on that path until a long-run sustainability is achieved. It may be that oil prices could be better than we forecast in the near term, but the factors that are making everybody pessimistic about the long-run prospects for oil, they remain, and they are substantial factors to consider. And therefore, a temporary relief should not be seen as something that negates all the need for adjustment and so on. And therefore, I would say, and second, others who have already spoken, that the agency of fiscal adjustment does not really change as a result of the oil prices. The agency to do broader reforms, structural reforms, is also there. These problems are difficult and will take time and discipline to do. Short-term fluctuations in the oil price should not be used as a distraction from the challenges ahead.
Okay, well, thank you. We're a few minutes over now, so I guess it's a good time to bring things to a close. I'd like to, of course, thank our partners at the IMF for launching the report with us. We're very pleased to work with all of you. Of course, the speakers today who joined and lended all these great insights and different points of view. It's much appreciated. We look forward to working with you again, and everyone who joined us today after a busy year of Zooms. And as we're wrapping up the year, we of course look forward to welcoming you again in future AGSIW events and programs. And we of course hope that you enjoy our publications, for some reading material over the holidays. So I hope everyone has a safe and restful and happy end of the year and holidays for those who are celebrating holidays. And we look forward to seeing you all again soon. Thank you very much.